Honourable Prime Minister, distinguished delegates, ladies and gentlemen, good morning. My name is Edward Faber. I'm the ADB country economist based in Port Moresby, Papua New Guinea, and I'm delighted to be here today to give a presentation update on the PNG economy. There are a few key themes I'd like to touch on today. The first is that we've seen better commodity prices in 2017 and in the first half of 2018, and that this has been feeding through to help the economy in terms of the growth and inflows of foreign exchange. Secondly, that we expect to see significant future growth coming from 2020 onwards with new resource projects and significant infrastructure investment. Thirdly, that the fiscal consolidation strategy of the government is on target. And lastly, that yes, Forex challenges remain, but the backlog has reduced. So firstly, looking at the growth and export picture. Total GDP, looking at the GDP, total GDP was 23 billion in 2017. The largest sector is the mining and petroleum. This is 25% or 5.8 billion. Then we have the non-mining sector, which is 75%. This consists of the agriculture, forestry and fishery, which is 4 billion or 18%. We have construction and real estate, which is 3.1 billion or 14%. We have wholesale and retail trade, which is 10%, 2.3 billion, and the public sector, which is 2.2 billion. The manufacturing sector still remains relatively small, 0.5 billion. Now, looking at the growth picture over the last 10 years, Papua New Guinea economy has grown in real GDP terms by 68% over the last 10 years, which is an average of more than 5% per annum in real GDP growth. And in 2017, the economy grew by 3%. This is the initial estimate from the Treasury. Now that was primarily driven from the mining sector, which is estimated to have grown by 10% in 2017. That was due to full-year production at Oktedi, enhanced production at the Ramu Nickel mine, and we also saw expanded production from the LNG plant. The non-mining sector did not show so much growth in the last few years, 0.2% in 2017 and 0.7% the year before that. And we'll look at that in a later slide. Now, just to look at the general picture, we can see that in 2010 to 2012, we had good high growth, and that was due to the LNG construction phase. And in particular, the non-mining sector was doing well. And then in 2014 and 2015, we had higher growth from the LNG sales coming on stream. In 2015, we had the difficulties from the commodity price collapse and also the end of the LNG investment phase, and we had the drought. So that's why we saw some struggle in that year. Now, taking a closer look at the economy is driven by exports, which were 9.6 billion in 2017, or 40% of GDP. Hydrocarbons are the largest percentage, 44%, or 4.2 billion. Metals, 3.5 billion, 36%, and agriculture, forestry and marine, 1.9 billion. LNG is the largest export, at 33% or 3.2 billion, followed by gold, which is 24%, 2.3 billion. Copper is also important, 607 million. And the largest agricultural export is palm oil, 415 million. Now, exports in terms of nominal value grew significantly in 2017 by 22%. This was due to improved global commodity prices And also we saw expanded output in a number of different segments of the economy. For example, copper, nickel, and cobalt, we all saw expanded output and better prices due to demand from China, especially for the electric car industry. Gold output was marginally the same, but we saw better prices, which is why we can see this improved trend here from gold. LNG and condensate, we can also see increased in 2017 due to improved prices and more output. Crude, on the other hand, we can see that it's been trending a little bit downwards over recent years, and that's due to maturing oil fields. Marine products were also higher, forest products relatively static, and agriculture was up due to more palm exports. I just want to take a quick look at some of the prices. This shows the price over the last 10 years. And we can see how a lot of commodities, as we all know, 2015 was really the low point, but that how the prices have improved since that time, and that has helped to provide stimulus to the PNG economy. Although recently we've seen this trade dispute between the USA and China, and that has meant that we've seen some prices just come off a little bit, for example, with copper. So that does remain a risk to the PNG a little bit. We can also see how the LNG price has improved. Now this is important for government revenues from the LNG project. Now, agriculture is the key segment for thousands of smallholders in the country, with estimated 85% of the population estimated to be living in rural areas. Agricultural exports were 689 million in 2017. Palm oil was the largest at 419 million. Now, if we look at the middle chart, this green line shows palm exports in tonnage, and we can see how palm has been a growing agricultural commodity export for PNG, up by 25% in the last 5 years and by 15% in 2017. Now, you do get seasonal variations, but we also have more production happening in that segment of the economy. Cocoa and coffee, we can see that the production has been a little more flat over the years. Now, this is due to the subdued price outlook, and also, of course, ongoing investment is needed in that sector. But the government is working on a number of initiatives, especially in cocoa, to try and stimulate increased exports in that area. So palm oil, 419 million, coffee, 141 million in 27. We also have cocoa, 63 million, and copra oil, 60 million. Now, a closer look at the non-mining sector over the last few years. We can see how the growth has been relatively lowish, and in 2015, as I mentioned before, how we had this slight contraction. If you look at the data, we can see that construction contracted by 14% in 2015, and that was due to the fact that we had the LNG investment cycle beforehand. We can also see agriculture went down, and that was due to the drought conditions. Now, looking at some of the key business surveys that we've seen over the last 3 years, asking business executives what's the key impediment, and it's foreign exchange currency, which comes out as one of the biggest concerns. And this arrived at a situation due to the fall in global commodity prices and the end of the LNG investment cycle. So we can say that that's also been contributing to a tougher environment. And we'll look at that more in a few slides' time. The other important thing to draw from this slide is that infrastructure is also a key impediment to doing business. So that's why increased investment in infrastructure will be good for the economy. Now, I just want to look quickly at the 2018 growth forecast. Now, the original growth forecast was in the region of 2 to 3%. This was due to APEC. APEC's expected to help boost construction, hotels and restaurants, transport and services. Also, we are still expecting expanded mining from operations like Ramuniko, and agriculture we're expecting to see continued growth, and especially coffee is expected to grow in 2018. Now, then of course we had the tragic earthquake in February, and the latest growth forecast from the Treasury Department is that they expect growth of about 1% in 2018, and the impact of the earthquake is supposed to have had a downward impact on growth of about 1.4%. So this is due to lost LNG exports, some lost gold exports from the Porgera mine, and also some reduced oil exports. And we can see that the oil and gas is expected to contract by 4.5% in 2018. Now, originally, there were fears that the contraction might be greater than that, but the LNG plant is now operating at greater capacity than before. So they're actually expecting to recoup up to 80% of the lost production. So that's why we can still expect to see a positive growth. ADB's latest forecast was 1.8% growth for 2018. And ANZ's forecast was 1.9%. One other factor to consider in the earthquake equation is reconstruction. And we know that there'll be a lot of reconstruction going into schools, hospitals, and public sector infrastructure. And as also private sector mining facilities were damaged and require some reconstruction. So that's an important part of the equation. Now, looking at 2019 and beyond, in 2019 we expect growth to accelerate to 3%, 3 to 4%, due to the rebound in LNG, oil and gold production. And looking ahead to 2020, we then expect the 2 new LNG projects to come on stream, and that will be a significant investment and lead to a new growth phase, what ANZ has called new super cycle in PNG. We also have Wafi-Golpu, which will be a 2.8 billion investment, new infrastructure, and we also have the China One Belt, One Road initiative, where they've potentially pledged 3 billion. Now, just on the Wafi-Golpu, it's also important to mention that this will be in an area where there's a lot of potential for agriculture, and they'll be putting roads into that mine, so it can also help the non-mining sector. So now look at the inflation, current account and foreign exchange. So inflation has been relatively high, but not out of line with other lower middle income countries. And we often expect the higher inflation for fast growing economies. It was 6.4% in 2016. Now this was due to also some drought conditions at the time when we saw the betel nut price high. It's come down to 4.7% in 2017. This can be attributed to the slightly slower economic conditions. We can also potentially say that some of the inflation could have been driven by foreign exchange shortages, because less goods are coming into the country, and so there would be more demand for the goods that are available. Now, in 2018, we're expecting inflation to be at about the 5% range. We're seeing some currency depreciation, which could contribute to some imported inflation. We're seeing tariffs and also some higher commodity prices, which could have some inflationary pass-through. And looking at the imports and exports trend of PNG, we can see that exports have been growing significantly. This was referred to in an earlier slide. And we also know that a big part of that is to do with the LNG, which has contributed to the trend in significantly more exports. That's the blue line. We can also see how the orange line, how the imports have trended downwards. That's due to the end of the LNG investment cycle and also due to less availability of foreign exchange. Now, that trade surplus translates to a current account surplus, which was 13.9% of GDP at 2017. Now, on the other hand, we can see, so that current account surplus basically translates to foreign exchange inflows coming into the country. On the other hand, we can see the orange line, which are neutralizing those inflows, and that represents outflows in the capital and financial account. Now, that is due to project debt repayments on the LNG project, which should be expected. So in other words, the boost on the blue is neutralized by part of the outflows in the orange. And it also relates to dividend payments to overseas investors. And also, we think there's a part of that that relates to exporters keeping a certain percentage of funds offshore. Now, looking at the foreign exchange reserves are about 1.6 billion at the end of May, which is 5 months of import. We haven't seen much change in the foreign exchange reserves over recent years due to the pressure on the foreign currency needs. Now, looking ahead, on the one hand, we could expect to see the foreign exchange reserves improve because we have some loans coming in from World Bank and ADB. But on the other hand, we know that there's a significant foreign exchange backlog in the country, and that this would need to be cleared, in theory, before we could see a significant improvement in the foreign exchange reserves. But even so, at 5 months of import, then it's sufficient. But we have to factor in the foreign exchange backlog. Now, that is reportedly reduced lately to 500 million from about 1 billion previously. Now, some of that improvement should have come from the improved commodity prices that we've been seeing, and also we've also seen a little bit of foreign exchange depreciation, which may have helped. So here's the exchange rate, and we can see that the exchange rate has actually depreciated against the US dollar by 3.8% over the last 12 months. And this is a change from the 12 months before that, when the exchange rate was relatively static. Now, a weaker currency can be beneficial because it can help attract dollars into the system, because the currency essentially becomes cheaper. So that can also help with the foreign exchange position of the country. Now, I'd just like to look at some recent fiscal outcomes. The fiscal deficit has shown a downward trend. This is due to the government's fiscal consolidation strategy. It fell to 2.4% of GDP in 2017, or 1.7 billion kina. That is down from 3.6 billion, or 6% of GDP in 2014. And in 2018, the government is targeting a deficit of 2.5% of GDP. Now, this is within the medium-term fiscal strategy of the government to maintain fiscal consolidation, which is a positive trend. On the other hand, of course, we also know that a shrinking deficit means less stimulus can be placed into the economy. Now, looking at the revenue side of the equation, we can see that revenues have been relatively flat over recent years, and this is due to the slower economy and more difficult conditions. But revenues were 15.6% of GDP, or 11.5 billion in 2017. They were actually 10% up from 2017 due to improved collections of GST. However, they're still below the 2014 level, just slightly lower. Now, the government is working on several initiatives to try and increase revenues, especially on the tax side. And this, for example, includes establishing a new large taxpayers office and new tax collection systems. Now, whether we expect to see more significant growth may depend on the trend in the economy, although we should also mention that the improved LNG prices more recently have been reported to have helped the government on the revenue side. Because the oil prices are higher, the LNG price is higher. Now, looking at the expenditure side of the equation, expenditures were 18% of GDP in 2017, or 13.3 billion kina. They were down, i.e. cut, by 2% from 2016, and they've been cut by 13.8% since 2014. So we can see that the government has made some significant cuts to the expenditure. Now, part of this expenditure cuts has been in the capital expenditure part of the budget, which is the area needed for growth. However, we can see that in the 2018 budget, here the government is planning to expand their capital expenditure component. Now, part of that's due to APEC, and that should help stimulate growth. We can also see at the bottom here, these are the costs of compensation of employees or personal emoluments. And that's been one area, so that's about 33% of total expenditures. And that's been one area that's been relatively difficult to control. But as part of the government's medium-term expenditure strategy, it does have a strategy to control expansion of that part of the expenditures. Now, looking at PNG's debt position, it was about 32% of GDP in the end of 2017. Now, that is lower than many of these countries we've shown here in Southeast Asia, where we have Thailand, Indonesia, and Vietnam with 40 to 50% debt to GDP ratios, and it's also lower than other countries in the Pacific, which also have 40 to 50%. However, we can also see how the debt of PNG jumped significantly in 2014, and that was due to the fiscal deficit, expansionary fiscal deficit at that time. Now, PNG has a cap of 35% to keep debt levels within under its Fiscal Responsibility Act, and PNG is also looking to reduce debt to 30% of GDP by 2022. Now, what is important, though, in the debt equation is to look at the interest costs, and we can see how interest costs have increased substantially in recent years to 1.5 billion kina in 2017, or 11.4% of expenditures. So if we compare the interest costs to peers, we can see that PNG, as a percentage of expenditure, the interest costs are higher than peers. Although as a percentage of GDP, there are some others that are higher. So in terms of looking at the interest part of the equation, we can say that PNG has sufficient levels of debt currently, and that is why under the medium-term debt strategy, PNG is looking at ways to reduce its interest costs and to diversify its debt profile. Now, to do this, moving more towards concessional lending from multilaterals. ADB recently approved a 300 million loan for PNG for budget support, and the World Bank is also in the process of approving a 300 million loans. ADB's in the process already dispersed 100 million, and World Bank is due to disperse 150 million this year. So this will help PNG to diversify its debt profile and to create headroom, breathing room. PNG is also looking at a sovereign debt bond in September for 500 million. So all of this will help PNG to refinance its debt profile, create headroom. And we know that in the domestic debt market, that's been relatively saturated, and the debt's been slightly shorter term with higher interest rates. So it will take pressure off the domestic debt market and allow for diversification. Now, before I close, I just want to touch on a few themes on the economy. The first is that, as we know, PNG economy has the ability to the commodity price cycles. So this is why we talk about the Sovereign Wealth Fund, so that in good periods, PNG can sweep revenues into the Sovereign Wealth Fund, and that in periods of shock, that Sovereign Wealth Fund can then be tapped on. The Sovereign Wealth Fund would also provide a lot of comfort to rating agencies and external investors if they know that PNG has that cushion. The second thing to mention is that the next investment cycle, we know that it will come with social and political risks. So it's important for PNG to get the best deal from that. And it's also important for investors to want PNG to get the best deal for the whole population to benefit. The third point is that, yes, PNG has significant ongoing investment in infrastructure as needed, in roads and electricity. ADB has a forward pipeline of 1.5 billion over the next 3 years. Infrastructure can help to open up markets and to reduce business costs. Manufacturing, forestries and fisheries, significant potential exists there for PNG in downstream processing. It has its challenges, but this is an area that the government's also looking to expand, for example, with the Pacific Marine Industrial Zone in Madang. And as we've also heard, agriculture and tourism can help to offer diversification so that PNG can better weather commodity price cycles and shocks. So just to summarize, so we can say that, yes, PNG has shown resilience. We've come through some of the most difficult times, which were in 2015, and that we are seeing some improvement due to better commodity prices in particular. Better commodity prices are helping to lift growth, improve the foreign exchange position, and also the revenue position of the government. Although risks also remain with commodity prices, as we know with the China-USA trade dispute. Secondly, that we know that there are ongoing forex challenges, but that these have reduced and that will get better with if commodity prices stay high, and also with some continued depreciation if we see that in the foreign exchange. Thirdly, that the fiscal consolidation strategy of the government is on target, and this can provide us with significant comfort. And lastly, just to conclude by saying that, yes, we expect significant investments coming into PNG from 2020 onwards, and this will significantly help to boost growth and gives us a very positive medium-term outlook. Thank you very much.